Okay, let's talk about the market here. From time to time when I have conversations with people about the market, they always bring up 2008. And so I just want to take a second to give you a simple rule that you can use that would have avoided 2008. The smart money that was looking at the market in 2006 and 2007 knew to get out in the fourth quarter of 2007 and in the first quarter, the first month actually of 2008. And I'm going to show you how it's done. So, if I could give you one simple rule, one simple effective rule to avoid bear markets, it would be to watch the 200-day moving average. Now, if you are not familiar with moving averages, I suggest you go to this website, investopedia.com. They have a great glossary of investment terms. Look up moving averages, specifically the 200-day moving average, to get an explanation of how it's calculated. But all you need to know is this: there's a 75% correlation between all three major market averages. That is the Dow Jones Industrial Average, the S&P 500 Index, and the Nasdaq Composite, and all 8,000 stocks in the American stock exchanges. So if they go down, okay, all 8,000 stocks in the market are going to go down with them. And when that bear correction gets in excess of 5%, that correlation jumps from 75% and begins to approach 1. So we watch the three major market averages closely, and we watch what they do in relation to their 200-day moving average. Now, you're looking at a picture right now of the Dow Jones Industrial Average in 2006 and 2007 on the lead in to 2008. This is price. This is your 50-day moving average, the blue line here, and the red line is your 200-day moving average. They're used as gauges of investor sentiment. So what you want to see, and this right here, 2006, 2007, is a nice healthy uptrend, is an upward sloping 200-day moving average, an upward sloping 50-day moving average, and you want to see price respecting both the 50 and the 200-day moving average. Okay? So even if you didn't have these moving averages, if we took them off of the screen and we just put a simple trend line here, you can see that there's a nice, well-defined uptrend in '06 and '07, leading in to the fourth quarter of 2007. Now, the first heads up that you had, okay, that something was slowing down, okay, not imminent danger, but something was slowing down, was that this high here, I believe in October of 2007, was unable to exceed this high here in July of 2007. Okay, that's known as creation of resistance. And when a market cannot break out from a previous high, it's saying to you that it has the potential to begin to slow down, to begin to change trend. And at that point in time, that's what we're looking out for in this chart. Now, as we move forward, okay, in November of 2007, we have a trend break. Okay, for the first time in well over a year and a half, this market closes underneath this trend line here. And if you take a look at what's happening in relation to the 200-day moving average, again, back to our red line here, you see that for the first time in about 18 months here. This is a chart of the past 18 months of the Dow Jones Industrial Average starting in mid 2006. It is unable, okay, to keep above the 200-day moving average, and that's a major red flag. Okay, so your first, warning was that it was unable to take out previous resistance. Your second warning was that the 200-day moving average was taken out. Now, at this point in time, there is really no good reason to be in this market. But let's say you're a buy and hold person. You got into the market back in '04 or '05, and you're just holding on, and you have to draw a line in the sand. Your last line in the sand at this point in time, okay, is this support level here. Okay, after the trend line is broken, after the 200-day moving average is broken, what we're looking for after the breaking of a trend, okay? And now see, the trend is gone now. So now it's all about price resistance and price support. The question now, okay, in December, okay, going into New Year's of 2008, is which way is this range going to break? It had trouble getting up above 14,000, and previously buyers did step in and keep it from dropping below 12,800. The question now is it going to be able to resume and create a new uptrend getting back over 14,000, or is it going to break down and have the potential to create a serious downtrend under 12,800? Okay? And so, in my own trading, when this pattern manifests, okay, when this pattern shows itself, okay, I'm automatically out of the market. I'm waiting for a break in either direction. Now I can make money whether or not the stocks go down or whether the stocks go up, because I'm a long short investor. I get long in bull markets, I get short in bear markets. But if you're a long only investor, and I know that most of the people listening to this video are, when you are seeing a pattern like this develop, it's time to get out of the market, and it's time to wait and see. You have to let the market prove to you that it's capable of sustaining higher prices. And right now, what it's telling you, okay, from February 2007 all the way through December 2007, is that all that it's capable of doing is going sideways. Okay, so as you all know, this range broke to the downside and didn't come back. The major market averages were all cut in half. So was everybody's net wealth. And so were most of the 8,000 stocks in the American stock exchanges. And it all started when it violated the 200-day moving average. So I showed you a little bit of analysis. I showed you, one way to look at the market. If I could give you one simple rule to help you manage your risk, according to what's happening in the overall market, it would be to watch what is happening with the 200-day moving average. Like I said, you can go to investopedia.com to look up moving averages. You can also get your stock charts from websites like stockcharts.com. They have charts of the major market averages right on their homepage that you can click on. freestockcharts.com, also another great website. They have prettier charts, nice, multicolor charts here. But if and you don't even have to take my word for it. I've done the research. I've gone back over the history of the markets, going back to the very beginning, okay, and the same pattern every time that there's a bear market happens. Okay, what you're looking at a chart right now is the Nasdaq Composite in 2000. Okay, this was a nice in 1999. I think the Nasdaq Composite was up like something like 99%. Okay, but when it failed, okay, at the very beginning of that failure, okay, here in April of 2000, it went below the 200-day moving average and never came back. Okay, next, okay, you want to go a little bit further back. Okay, this is 1988, 1980. This is the market crash of 1987. Okay, again, nice uptrend going into 1987. We crossed the 200-day here, and you had about 24 hours after the market crossed underneath the 200-day moving average to get out before this drop happened. Okay, let's say you want to go a little bit further back. Okay, these charts go all the way back to the very beginning of markets. Okay, this is 1929. What you're looking at here is the Roaring 20s, as they're called. This here in 1929, okay, it was the first warning sign before the major market crash of 1929. Okay, you could have used the 200-day moving average back in 1929, and it would have protected you from the bear market that was going to come after. Okay, so again, You look at the last 100 years of history, we have charts going all the way back to the beginning. Okay, it says to us loud and clear, do not be a long investor in this market when it's trading underneath the 200-day moving average. So I hope, that's one tip, one piece of advice that you can use to help manage your risk, to help time your entries and exits in the market, and hopefully, not ever have to endure a year like 2008 in your portfolio ever again. Take care.